Let's move on to strategy number 2. And this one is a little more nuanced, a little more complicated. And this one, again, is all over the personal finance sphere when you talk about fire and fine movement folks. And they're called 72T distributions, named after the specific part of the tax code where this is written. These are a little unique. These are something most people don't encounter.
I don't mind sharing. When I was studying for my original, CFP materials, and then even in practice, you hear about this, substantially equal periodic payments. This is somewhat sexy in the fact that if you're a math-minded person, you're like, wait a minute, I could actually retire at 35 and still get access to all my retirement assets or whatever portion of the retirement assets I need if I just did this cool little math thing and annuitized it. There's something about the financial mutant brain that I thought this was a cool endeavor. But I think, and we'll go through, and maybe you can even walk through, how does this work, Bo? But I will tell you, more of this is academic than what we've seen in real life.
That's exactly right. What a 72T distribution allows you to do is every year, it allows you to pull out a substantially equal periodic payment from your retirement account. So you can receive payments before 59.5 from those qualified retirement plans without penalties. Again, you are still subject to ordinary income tax, but you can waive the penalty so long as certain things are met, certain conditions. So a lot of times when people decide how they're going to use 72T, you really have to begin with the end in mind. You have to sort of backdoor into, okay, how much of an income do I need? And over what period of time do I need that income? So when it comes time for me to retire, how do I segregate my accounts in order to take advantage of 72T? So here's how it works. And this is sort of like the loose 30,000 foot overview. First, you want to choose your account. It can be a 401k account. It can be an IRA account. Oftentimes, individuals will split up their IRAs or split up their 401ks and specifically choose one account in which they're going to implement their 72T distributions so they can have some sort of guaranteed income stream. So they choose the type of account that they're going to use, and then they have to choose the payment method. Now, this is where it gets a little more complicated and a little more nuanced. There's really 3 different payment methods that you can select from. There's the RMD payment method, which is recalculated every year based on the portfolio value and your life expectancy. So this number will not be the exact same every year. It will fluctuate a little bit based on mortality factors, but it's substantially equal. That's why they don't say exactly equal, they say substantially. That's option number 1. Option number 2 is the amortization method, where essentially it kind of works like a mortgage. You pick the interest rate and the timeline, and it will amortize over a certain specific amount of time to pay you a guaranteed payment. Or the third way you can do is kind of a combination of the two. It's the annuitization method, where again, based on your mortality and a stated interest rate and a stated timeline, you can annuitize a specific payment over a specified period of time to receive a certain payment.
And this is this column right here, choose the payment. I think this is the part when I was the person learning all these concepts of how you get access to these large retirement accounts without paying all these penalties that you're so worried about and you're trying to avoid. I love that this was one of those things where you don't have to do it off the entire account.
That's right.
You can chisel this off, and it's a math calculation. This is why I think us financial mutants are drawn to these type of strategies, is because you can just figure out back into what will I need to be my bridge account to get me to that 59.5 period where I get access to everything, under a tax code, and can I back into the math of how I do it? But there is something you need to be aware of, because a lot of these you have to figure out, how long do I have to set this in for? Is this a set it? Because it is one of those things. If you choose a 72 distribution rule, once you choose, you get a lot of flexibility. We just laid out these 3 ways, but once the day you execute this, you're stuck with this. Hear me out on this. For 5 full years or until you turn 59.5. And it's not the shorter of those 2 numbers. It's the longer of those 2 numbers. So you need to really pay attention, because once you set it, you are locked in on this. So it is something that you kind of measure. Once again, measure twice, cut once to make sure you get this part right.
The longer your retirement window is, or the further you are away from 59.5, the more complicated this becomes. Because imagine if at age 34, in a entering into age 35, you're planning on taking advantage of 72T distributions to bridge you from 35 all the way out till 59 and a half, man, your calculations better have been spot on. You better have a really good bead on what your living expenses are. Or if you don't, you better have another source of funds, source of resources that can help you pay for it. So 72T can be attractive and it can be unique and it can give you a way to access your retirement dollars, but there's a lot that goes into it.
I do want to give the caveat because we said this earlier, but I want to make sure people didn't overlook it. If you have Roth assets and you're really excited because we love the tax-free growth, realize you don't truly get that access to the tax-free growth portion of this until you're 59 and a half. So make sure you understand there's a little caveat in the rule that you don't get to really grab that until you reach that age. So be careful with that.
All right, so let's talk about the pros and cons. The benefit, one of the pro of a 72T distribution is the accumulation process is pretty straightforward. You just save pre-tax, you follow the FOO, you max out your 401ks, you max out your IRAs. You don't have to get super complicated in how you are accumulating. That part of the process is pretty straightforward. And then it is tax advantaged again if you're in a higher tax bracket while you're accumulating and a lower tax bracket while you're decumulating. You get a bigger tax benefit when you are earning the dollars and you pay lower taxes when you go to pull those dollars out. But there are cons with 72Ts.
Yeah, I mean, there's some complexity here.
It's
so there's risk.
complicated.
I mean, especially think about somebody, you gave the example of 34, but I'll even get a little closer and say, if you did this like you're between 45 and 50, you know you're locking yourself onto this for the next 10 years.
Over
that
a
could be
decade.
somewhat scary. And by the way, there's some complexity. And if you mess this up, the penalties and the costs could be pretty severe. So that's definitely something that probably keeps people being a little nervous about, hey, what am I not thinking about or what unintended consequence will I create here?
Yeah, and you already mentioned this. There's very little flexibility. In the beginning, you can have some flexibility in terms of how big the account is that you establish the payments on and what method you use to calculate the payments. But once the timeline starts, you're locked in. You can't change that a touch. So these are really interesting and it's really a fun academic exercise. But I think it's worth noting, and we'd be doing a disservice if we didn't acknowledge this, for most of our folks who implement early retirement and enter into FIRE or enter into FINE, while 72T is something we might have a conversation around and it's something we might investigate, I feel like it's much more academic than it is practicable. A lot of our folks who actually enter into retirement to pay for the living expenses, this isn't one that we see being the most often used method to provide for retirement living expenses.
Well, I find working with a number of FIRE movement individuals is that these typically, if you're going to be, because anybody in the FIRE movement is saving large sums of their income. I'm talking 40, 50, even 60% of your gross income. So for you to be able to still have a life and to save 40 to 60% of your income, you probably make a good
You have to
living.
have big income, yeah.
And it's not uncommon also for a lot of these FIRE people to have restricted stock units because maybe they work for a tech startup or some company out there that incentivize their retention through stock options, through RSUs. So it's not uncommon that you just naturally are going to have tax favored accounts, but you're also going to have big after tax assets. And so you said it exactly right. A lot of times these are more academic, analysis because it's not ideal and the complexity and you locked in for a decade or longer. It can be somewhat scary.